Are emerging markets the new subprime? So there's a lot of research and data coming out about emerging markets, whether that is foreigners pulling out their capital or net capital outflows, or Moody's, which is now projecting an enormous increase in emerging market government bond and corporate bond defaults in the next 12 or so months. Or my friend Daniel Lacaille just put out a piece citing this chart talking about how emerging market foreign exchange reserves are declining at an astounding $1.5 billion per day, according to Bloomberg. It's nuts. Or this story about how the Chinese economy is drastically hurting emerging markets. For those that are familiar with my channel for a long time, I've been warning about problems in emerging markets, and a lot of different problems. Actually, I call them enormous headwinds for well over 9 months, basically all of 2019. A lot of the factors I was seeing, whether that was problems in the Chinese economy, commodity prices, I was especially worried about the Chinese economy slowing down, and then problems with oil and energy and also base metals. So I listed this out from that video where I just showed you the screenshot from August. And I was warning about this many, many months before the coronavirus. The coronavirus actually just exacerbated and accelerated the problems that I highlighted here all of 2019. So that was China's economy was slowing down, too much total debt in emerging market economies, especially dollar-denominated debt, capital outflows leaving emerging markets, which is accelerating lately too, although that was getting bad over the summer in 2019, way before the coronavirus, and then a bear market in a lot of exports that emerging markets concentrate on. Emerging markets either export luxury goods or they export a lot of raw materials or commodities, whether that's base metals, energy, food commodities. This is what's happened to the oil price. There are a lot of emerging markets with enormous amounts of energy production. Some countries, their oil revenues make up an enormous amount of their government budgets. So the oil price doing this, it's unbelievable economic devastation. So yes, there's been a rally in the oil price, but still that's a chart showing that even though we have had a rally, look at all the damage that's been done. This is clearly a bear market. And as of now, this is still only a bear market rally. I do not see any signs that demand is really starting to come back for the US and European Union yet, although we are seeing some signs that a little bit of oil demand and gasoline demand is starting to come back in China. But overall, a lot of traveling because of the coronavirus, it's going to take a long time probably for traveling to come back. This is a chart of the copper price. So I showed where the bear market started. The copper price, similar to the oil price, has had a bear market rally. However, I'm not convinced that the bear market is over, given what Nolan Watson of Sandstorm Gold and the other CEOs and senior executives at precious metal royalty and streaming companies have talked about with problems with the copper miners and how desperate for cash so many of these producing copper miners are. So I think there will be more pain for copper miners, and a lot of emerging markets, whether that's Chile and many others, are heavily focused on mining, especially base metals, more than precious metals like gold. This is a chart of the copper miners ETF. Again, it's had a bear market rally from what it looks like, in my opinion, similar to the copper price, but it's still down enormously from where it was prior to the coronavirus accelerating end of January and early February. This is a performance update of the Rogers International Commodity Index. If you're not familiar, this is the index that legendary investor Jim Rogers came up with. And his commodity index is different because it actually has a lot more exposure to agricultural commodities and soft commodities. The weighting in there is a lot larger than pretty much every other single commodity index or commodity ETF. So there's a lot more exposure. He wrote an entire book about this I read many years ago called Hot Commodities, if you want to learn more about this. So there's a lot more coffee contracts and other agricultural commodities in the weighting. But as you can see there on your screen, this commodity index got absolutely killed year to date. It's down over 30%. In a single month, it's down almost 30%. It's just gotten absolutely obliterated. Now, from 1998 to 2018, it did have enormous returns, as you can see there on your screen, 119.43%. But lately, it's gotten killed. So if you are a longer-term contrarian investor, maybe this is a buying opportunity. Maybe. However, What we're seeing now is commodity prices are still going down while people are paying more at the grocery store, at least here in the US, with the data that we're seeing coming out from the Federal Reserve and elsewhere. Grocery store prices are up, record levels actually for April for a single month over the last 30, 40 years, while commodity prices are getting killed. So this might be a contrarian opportunity there because of the higher food prices, and eventually that might mean higher commodity prices. And I think this commodities index is better weighted compared to the other one if you study this more. This might be a contrarian opportunity for patient investors who are willing to buy value and wait potentially years from now. Could potentially get a lot more returns. So how are Saudi Arabia, China, and India doing with reserves? Saudi Arabia alone lost 27 billion in reserves in March, according to Goldman Sachs, and it is one of the countries with the best capacity to endure the current crisis. They have an enormous sovereign wealth fund, and they do have oil, so they're paid in dollars because of the petrodollar. So they are getting dollars, although they're getting less dollars because the oil price is being so low. By the way, I'm taking pieces here from my friend Daniel Akaye's article from early May about emerging market problems. So these are snippets from his article there, Daniel Akaye's excellent article. Hopefully I'll be able to get him on for an interview soon again. So China officially holds 3 trillion in foreign exchange reserves. I don't believe that number, so do many other China experts, despite the crisis, is also amongst the strongest countries in reserves, but apparently large level is offset by large US dollar denominated debt. Liability, China's 60% of reserves are there to cover existing liabilities. According to Daniel Akaye, India is one of the strongest countries because they import a lot of commodities and commodity prices have crashed. This is a chart from the end of December to almost the end of April, showing how the currencies have reacted. A lot of emerging market currencies and a few more developed economies like Hong Kong and Taiwan have reacted relative to the US dollar. So Brazil, South Africa, Mexico, Colombia, Russia, their currencies have gotten hit worse compared to some of the other currencies. Remember, the dollar index is strong, the trade weighted dollar index is strong, and the Congress here in the US wants to get away with a lot more spending the stronger the dollar is on a relative basis. What is causing this collapse in reserves and rising dollar shortage? One of the main problems is global trade is not functioning, but the decline in global trade and economic activity due to the forced lockdown weakens export revenues. The outlook for 2020 is bleak, with trade possibly declining by so these are official numbers, it's probably even worse than that, by 13% and 32% according to the World Trade Organization. It's probably even worse than that. They're probably being overly optimistic. Some recovery is expected in 2021. If there's not a bunch of second waves, but the likelihood of recovering 2019 global trade activity before 2023 is small. Wow. Collapse in commodity prices destroys the trade balance of producer nations. So these are mostly emerging markets that export a lot of commodities, mostly to China. Not only demand is falling to unprecedented levels, but storage is also filling up rapidly, and overcapacity at producer nations is building to decade highs. This problem is not happening just in oil and natural gas, but also in coal, aluminum, and copper. Local currency collapse leads to central bank intervention. Central banks in emerging economies were smart in 2008 to 2011, kept their reserves at very good levels, significantly above foreign currency liabilities. However, the recent slump in many currencies relative to the dollar has caught many emerging market central banks unprepared. Despite the massive increase in balance sheet of the Federal Reserve and almost unlimited quantitative easing, many emerging market currencies have collapsed and led to their central banks to sell dollars to defend the currency, a big mistake, as reserves fall and the currency then starts getting attacked and remains weak. Since 2009, many emerging markets have ignored the risk of building imbalances and have entered into large twin deficits, fiscal and trade, as well as issued record level of US dollar denominated debt because they were trading with China. And they were expecting the dollar after 2011, when it set record lows, I think, on the dollar index, to remain weak. Issued record level dollar denominated debt because domestic and international investors did not want local currency risk. Also because interest rates on a relative basis were cheaper to issue dollar denominated debt, and they were betting that the trend of weak dollar would remain. This means that emerging markets face a massive wall of US dollar denominated maturities of more than $2 trillion in the next 2 years, while refinancing and new debt requirements soar. The Federal Reserve will continue to increase money supply, but investors have abandoned the risky carry trade of, I think there was a spelling error there, of using cheap dollars to buy high-risk emerging market exposure. Understandably, investors have pulled more than $120 billion in emerging market financial assets in March. That was an article from Daniel Akaye that I summarized parts of it. Is this a great opportunity for China to extend massive loans in yuan to address the rising shortage of dollars? I think China has a lot of problems in their economy. According to Daniel Akaye, and I summarized, his article here about problems with the Chinese economy, it is not an opportunity for China to address the rising shortage of dollars because China's banks are also running out of dollars, according to the Wall Street Journal in a recent article. Finally, emerging markets are not earning their dollars normally. This is the main problem here, the global cash flow problem. A lot of these emerging market governments, a lot of these emerging market private companies are not able to service their debts. They're not able to pay off part or all of their dollar-denominated debt that they would have earned through normal global trade, and also service some of those forward dollar swaps, which are an enormous, that most people are not talking about, although the Bank of International Settlements was warning about this in November and December, only about 6 or 7 months ago. So unfortunately, I think the problems with emerging markets will get worse before they get better, unless there is a big commodity price rally or the dollar starts to get fairly weak relative to a lot of other currencies.